Hello guys, welcome to Frequency and FX Trading channel, and in today's video I want to quickly take you over a few course about the volatility 25 index, and I wanted you to learn how to trade it as well. But of the vast records of the trades people do take, there's so many challenges with how people take trades these days, and there's so many, of course, contradictions and as to how trades are really ought to be taken and how people think they are being taken. So what we're going to start by learning today is a simple strategy. I term the momentum move ability, market changing, structural, you know, biases. So many people predict the markets from a time frame, and that's the 1 minute. People often want to trade very fast, and so you know what they do, they go into the 1 minute time frame. But then when you go into the 1 minute time frame of the most vast major records, let me just pull out this so I show you a few things. And I'm just gonna use the brush. People have been trading strategy based on market momentum, but of course this is what market does overall. And in a 1 minute time frame, the market usually moves like it doesn't have a direction. And there are times the market moves very long, very predictable. But most at times the market doesn't move that predictable because of the so many things that the market does aside of our knowledge. And that's a simple terminology. I'll just go to the 1 hour time frame and show you. You see, 1 hour time frame moves all of its momentum via 1 hour. This particular movement that went up took place in within hours. All right, and of this movement that happened, you know what happened as well? All of these movements are based on range. Markets is ranging. And then when you ask yourself, 1 hour did this one, right? Let me just cancel this so I show you what I want to show you. 1 hour did this. You see, 1 hour took all the 1 hour as a time frame to have reproduced a candle that formed this and formed this and formed even a longer one, a shorter candle, a mid-sized candle, and then this red candle we saw here. And if I took you all the way to the 1 minute time frame, you'd see that of all the time the market has been doing all of these things, 1 minute time frame was busy dancing around under 1 hour. So because 1 minute time frame keeps dancing under 1 hour, it is certain that you cannot predict the market rightfully from the 1 minute time frame if you did not check it out from the 1 hour. The 1 hour is a basic time frame I advise all the people who are trading forex to work with. Let us go into the 30 minutes time frame. You see, of the 30 minutes time frame, this movement that has ranged over and over again and keeps ranging would have disturbed so many people. So many people must have wanted to trade here, and that is, you know, the market does not have a momentum here. This is what the market basically did all this while. And because the market did all this, it is not going to a direction. The market doesn't currently have a direction it is looking to move with at that level. So therefore, it wouldn't have been a best opinion to trade. This what market basically does is this. These are the theory movements of the market. Sorry, that was not the plan. The market goes like this. It comes, it goes, and it ranges, and then it moves into a direction. So of all the times the market is moving in this direction, which is upwardly, ranging, and downwardly, you wanted to know when the market gave a straight momentum. When the market gave a straight momentum, and decided to move in a certain direction. That is when you're going to enter for a trade. Do, don't enter when the market is ranging. And there are various ways to know the market is ranging. The reason people do not spot markets when it starts to range is the fact that market moves in time frames. All of this momentum you see up here, all of this momentum you see up here, if I took you to a bigger time frame, but then what I want to do is I want to draw a real, you know, a real technical technical object on the screen, so you just see into what I am telling you about. Well, I want to change these pixels into something bigger so it explains better what I want it to. Oh yeah, the market, I mean, Derek is getting, MetaTrader is improving in its ability, and of course it was not like this before, but you can see it has an upgrade feature on it, something better. Yeah, so of this movement, you see, the bigger the time frame you are, the more advantage you have over this market. That is why I encourage everybody who is trading with me to be patient. I encourage every of my students who, trade with my signals to patiently wait for the market. You see, all of this thing, right, represented a basic momentum. What can I say about the biggest cycle of the market? Professional traders recommend you trading the highest form of time frame. If possible, they recommend you going weekly or monthly. That's because of every single movement. It actually represents a basic candle in a bigger time frame. When market carries out a possession, when market carries out a momentum in a particular time frame, when you zoom out to the other side of what was actually happening, you would see that the market is doing what we call a candlestick pullover in the bigger time frame. Yes, you can see the day one time frame keeps moving smoothly. And what I can tell you about time frames is that when they are really big, they tend to move more predictably and more smoothly. I mean, just take a look at the week one time frame, right? I and all of my students decided to start trading from the week one time frame, because just take a look at the week one. The week one moves in what we call market structure, as you can see on the screen, and this market structure keeps creating another market structure. You see, market moved up, there was a red candle, a green candle was formed, a red candle retraced it, another green candle went up, another red candle came down. Now, imagine all you did was trading market structure. You would have made huge amount of profit. Why? Because it was actually probable and more predictable in a bigger time frame. So what am I going to tell you? Um, of all the time frames there are in this market, we all know on the MetaTrader app, you only get it from the monthly, right? So therefore, if you are trying to trade like I do, if you're trying to trade forex, if you're trying to win big in this market, you need to start trading one strategy I call the market structure strategy. And the time frame of which I recommend does not surpass the monthly time frame and the week one time frame, because every time frame has its momentum. And just take a look at the pips that could have been amounted here. From this point, let us say you took a market structure trade. Let me use the brush so you can see it properly. You took a market structure. Yes. The market structure, how do you trade it? When you see a red candle and there is a green candle, Immediately there comes a red candle if it was a sell. And the red candle is where you enter a trade. And the red candle tells you to sell. And when you sell based on the red candle analysis, the market will go to your direction. Why? Because a market structure has been created. But then, how many pips do you decide to take? This is when it gets really tricky and messy. The pips we talk about in time frames is based on how much you are willing to either risk or win. So what that suggests is that it doesn't matter whether you are trying to take 25 pips. It doesn't matter whether you're trying to take 50 pips. It doesn't matter whether you're trying to take 100 pips. What matters is the analysis you are trading or you are analyzing with. So I can tell you, if you took a trade from the week 1 time frame and your analysis was a sell, the first 25 pips that you gathered could have been piled up by you for a potential futuristic trade momentum. If you piled it up, you now have a trading ability to gather up that little pips. But then, just like it was advised, you can only trade with what you can afford to risk. So what that tells us is that trading with what you can afford to risk is basically trading the required leverage of your stop loss. We all know that the stop losses that would be required of you to carry out a trade in the week 1 time frame is going to be as huge as, let us call it 200. Let us just calculate these pips. Imagine we wanted to trade this this particular strategy, this market momentum, and then this green line, right? Let me just cover this up so you see it properly. You see this green line over here? That's your trade. After the red candle, the green candle you saw was the trade you must have taken. So if we wanted to calculate our pips, this is how we do it. We take out the ruler tool and then we move the cursor from where it is to where we want it to be. This is 83 watts of pips. Well, I tell you, if it was just a little bit 5, let us go into a time frame like 5 minutes and try to understand the value of pips in this scenario. You see, over here, if I took a trade, 4.5, let me just take a quick trade so you can see how it goes. Yeah, of course, I already took a trade. So we're trying to analyze how many US dollar costs 5 pips, just 5 pips. 5 pips, how many US dollar? So this is 4, okay, let's say this is, to get $1, you need to chase the 20 pips, right? The 20 pips. But let's just say this is where our 20 pips ought to be. And so let's say we calculated this. So 20 equals 2 gives us 1 US dollar profit. But then let us go to a bigger time frame, which is now we now have an idea of how much 20 how much how much $1 is in the pips. So let's say we're trying to get our stop loss. Of course, there's no trade here, but just for reference purposes, I'm gonna close the trade right away. And if I only risked 9 cents for, 21 cents is enough for me to risk. That's nothing for me. Of course, it's a real account, just so you know. And so we say we're trying to see how many pips cost 1 pip. Right, let's say this trade was taken. So we all know if 2, right, equals $1, 10 No, 20 equals $10, right? So we're gonna just check out the lot size here. 20 equals $10. So if we were gonna use the calculator, there's gonna be some sort of contradiction, but calculation would still be required. Of course, I'll just take you guys to the calculator. Yeah, I'll take you guys to the calculator so you see this in my calculation base. So two uh um 2 times, no, 1 times 2 equals 2. Now 2 times 142 equals $284. That is to say, if we were trading this, we would have needed a minimum. I mean, if that was the pips, right? If that was the required pips, to get it done, you might have required all that amount. Okay, let us say if 20, if 2 was, if 2 was 1, 20 is going to be 10, right? 200 is going to be 100. So that calculation of ours was kind of accurate, but we need to get it right. So therefore, if we were trading with the minimum lot size of this particular pair, if it was just 200, if it was just 200, if 2, okay, we're gonna do the calculation again. We'll say if 2 equals 1 USD, then 4 equals, no, 20 equals 10. Of course, 200 equals 100. Yeah, so 200 equals 100. That is to say, if our risk was at least 200, our stop loss, our required stop loss amount would be 100 US dollar. So with 100 US dollar risk, okay, this is when the analysis you do gets serious. We're going to say with 100 US dollar risk, how much are you willing to make? With 100 US dollar risk, how much would you be willing to make if you risked $100? Would you rather make $25 after risking $100, or would you wait for the market? Because if we traded this, right? If we traded this with $200, if we traded this with $100, we could have decided to take 1:1 risk to reward ratio, which would have been, if it was 200, we would go 200 equals how much? 200 equals $100, right? 200 equals $100, and yeah, 200 equals. So if we took 1:1, it worked. That is to say, of all the $100 we raised, we were able to make 1:1. You know why I brought you to the week one? I brought you to the week one so that you can see how clearly the market moves and why you can choose synthetic indices over all the peers they are. Because if it was just forex trading, if it was just forex might not rightfully yield you all of this accuracy. Synthetic pair happens to be the best of all the pairs in the market. So this is volatility 25 index, and within the range of, you know, 2 years, you can see how well the market is moving. So why do professional traders choose synthetic indices? Well, the reason being is that synthetic indices tend to move more into profitability when properly analyzed than forex pairs. Why forex pairs is not potentially chosen by everybody is because of the numerous amount of spikes there could be, and even in the monthly time frame, um, forex pairs are not as predictable as they ought to be. But then, volatility indices, these crypto pairs work out miraculously, yielding for you all the desired profits, all of those, all of those predictable momentum of the market can be anticipated on, could be anticipated for on volatility indices. So that's why we say choose to trade volatility indices, choose to trade with deriv, and always wait for a longer period before cashing out. What can I say? If the monthly, you have to use the highest form of time frame here, and the scope is to risk as little as possible or as much as possible. This is $154, but you see, immediately this trade was taken, it went into a low of $104. But if you waited, and it was just in 1 month, but how much could you have made if you traded a time frame lesser than, you know, than the monthly? I mean, this was how many months ago was this? This was on the this was June, right? This was this was um, a month before June, right? So there was this strategy I made use of, which was the market structure, and I applied it on all the time frames they were, all the pairs they were, not all the time frames, all the pairs they were on one particular time frame, which was the 1 hour time frame. And what the market did because of 1 hour was that it showed us the market does not actually respect 1 hour at all. It ate up all our money. We didn't make any profit from that. But I can assure you that when you come into the monthly time frame, you can gamble full, you know, you can go full margin on it. The the monthly time frame moves in more profitability than any other younger time frame. And because anytime a market moves in a momentum, right? Anytime a market moves in a momentum in a particular time frame, you should always know that there was a bigger time frame behind it that is not moving in that direction. It only represented a candle in a time frame higher, but because it was on a lower time frame, it represented so many loser trades, which could have meant that if only you stayed longer in that particular trade of which you were just opening and closing position in the right time frame, you would have had it right because you waited for the right strategy. And when the right strategy showed forth its level, you took advantage of it. So guys, this is going to be the end of the video for today. Thank you for watching. This is Frequency in FX Trading Channel. See you in my next video. Bye for now and peace out.